The U.S. will most certainly be in another recession by the year 2020. And here's why I say that. The content included in this video. First, we're going to go over the meaning, just as a refresher, of an economic recession. Next, we're going to take a look at some of the yield curves, mainly the 10-year and the 3-month, to see what kind of insight we can get there. We'll then look at current signs that are in the real estate market, specifically looking at U.S. home prices, how those are trending. And then we'll also take a look, finally, at the Dow Jones Industrial Average historically to see what kind of insight that we can garner there. And lastly, we'll bring it all together for a comprehensive plan. So what is a recession? Commonly, a recession is characterized by a significant decline in economic production. The specific definition is 2 consecutive quarters of negative economic growth, and this is characterized by a country's gross domestic product, or GDP for short. So let's take a look at the 10-year Treasury minus the 3-month Treasury. The first line on your screen is representing the zero area. That means that there is no difference between the 10-year Treasury and the 3-month Treasury. Next, we're going to plot historical prices that go back in time all the way to the late 80s. So if we take a look at this first area, this gray vertical line on your screen right here represents an area of recession historically. So what we can see is that in May of 1989, the spread between the 10-year Treasury and the 3-month Treasury actually went negative. In other words, it went below this red line. That was then followed sometime within the next 18 months, in July of 1990 through March of 1991, by a recessionary period. If we follow this line, again, we have a recession. August of 2000, the line dips below the red, as you can see, and then within 18 months of it dipping, from March 2001 to October 2001, we entered into another economic recession. Next, we'll take a look at when the line dipped in August of 2006, as seen here. And as we all remember, December 2007 to May 2009, we entered into the Great Recession, and there was a housing collapse. March of 2019, yet again, this year, 2019, the 10-year Treasury and the 3-month Treasury fell to a negative value. So what does this mean? Historically, what that would indicate is that sometime within the next 12 to 18 months we would enter into a recessionary period. As you can see happening here, followed by a recession, a dip here, followed by a recession, a dip here, followed by a recession, and then we have just now had another dip. The last thing I want to point out, because this will play into the final plan, is that it is only after the dip and then a recovery that we actually enter into the recessionary period. So what do I mean by that? So if we actually look at this chart, the line dips below the zero value and then makes it above the zero value. In other words, it recovers and goes back positive before the recession starts. So here we have a dip to a negative value. It recovers back to a positive value, and then the recession begins. Here we have a dip below, it recovers back to a positive value, and then the recession begins. So this would be a leading indicator for a recession. So just because this has dipped below this area does not mean that we are going to enter into a recession tomorrow. However, it does mean historically that we will probably enter into a recession in the next 12 to 18 months. But one indicator that we can use is the actual recovery of this back to a positive value. That would mean that we were probably just in front of the next recessionary period. If you like this video or other videos that we create on this channel, please subscribe. Also consider leaving us a comment with what we're doing well, things that we could do better, video ideas, things that you may want to see, and hit that like button because it helps with the algorithms. Okay, so here we're going to take a look at the real estate market to see what kind of information we can get here. What you can see at the bottom of the page is we have the years of 1990 leading till 2018, and then we have home prices here on the left. Home prices started at 120,000 and ranged to 320,000 for the purposes of this chart. So what this is the median sales price of U.S. homes sold. This red line indicates that median sales price. We can see it trending all the way up into 2007, following into this recession. Recessions are labeled by, these are the same recessionary periods in the previous chart. They're these gray vertical lines here, these areas shaded in gray. You can see the pricing declining into 2009, and then currently this is what the median sales price of U.S. homes has done since 2009. What we're going to draw here is just a channel. This is known as a channel in technical analysis, and it can help us, kind of reveal some of the things that are underlying in the, well, typically I would say price action when looking at a stock, but here we're going to look at the price of homes. And so this channel delineates the high and the low trends in the median sales price of U.S. homes sold. We're going to split the value of these two blue lines using this green line. This is a median line. What this does is it splits the difference between the high of the channel, the low of the channel. And what this is this is showing the trend of the average median sales price over a period of time. So what happens is that the price always reverts back to this mean, this average right here in the middle. The next thing we'll do, which is common in technical analysis, is we'll take one standard deviation outside of this blue line on the bottom and outside of the blue line on the top, and we'll draw another line. And what this does is this helps us kind of know when home prices are overbought or oversold. So what we would look at is where we are currently on the home price. We have a median sales price of a home right at around $320,000 in the United States currently. So using this technical analysis, what we can figure out is that if prices go above this blue line, it's a safe bet that home prices are overvalued and they need to come down based on historical trends in prices that we see here. If the price falls down below this blue line, so if it falls to any area between this blue line and this green line, then home prices are very, very low historically. All right, so that is the second thing that we can use to look. Currently, we're on the higher range. So if you were to follow this home price up here, and you see it coming close to the high range of this blue line, the next move, the next expected direction would be to the downside. Again, we've come up here, we've touched this blue line, so the next expected direction would be to the downside, which correlates with a recessionary period. You can see in these gray areas you have a decline in home prices. Here is another decline in home prices, okay? That is what we would expect here, but it presents opportunity. As we look at these bands, the blue line here and the blue line here, if the median sales price dips to an area of around somewhere in here, which would fall around 290,000, it would be a safe bet that home prices are now undervalued, and it would be a good time to invest in real estate. This would probably happen post-recession. All right, so jumping over to the U.S. stock market, there's a couple of things I want to point out here. Mainly, I want to talk about how we can look at historical price movement and the location of an oscillator such as this stochastic here. What I'm using is just a stochastic slow, but a relative strength or RSI indicator can be used in just the same way. But I want to look at historical movements just before going into and coming out of recessionary periods in order to see what type of information we can pull from the charts. So again, I'm going to draw this vertical gray area to highlight a recessionary period. So this is post-tech bubble recession that happened in the early 2000s. So in the early 2000s, we had the tech bubble, the NASDAQ fell significantly in value, and what we see is a decline in price here. Again, we have the housing crisis, so starting in 2007, leading into the early parts of 2009, we have this significant decline in the market, and so you can see that right here in this gray shaded area. But what I want to point out is that prior to going into this recession, prior to the tech bubble bursting, on the monthly chart of the Dow Jones Industrial Average, our oscillator reached an area above this blue line, which means that it was overbought. All right, that means that the prices were high relative to previous price action. And so looking at a monthly chart, when we reach this area on our oscillator, it's a good sign that the next viable direction should be to the downside, as we can see here. But what happens? What happens is that eventually, at some point during the recession, the indicator comes to oversold, which means that it is now a value opportunity. It's a good time to invest in equities. So if we invest in the equities here, you can see that there was a lot of appreciation that took place after. All right. Again, here you see the price going over this area of 80, which means that these are overbought securities, that these are priced too high. All of a sudden, as this indicator digests over the period of the next 18 months or so, the indicator comes down to an oversold position during the recession, and then at the very bottom, the indicator triggers back up above this 20 line. I'm going to highlight this area, and this area, okay? But it comes back up above the 20 line, and then we lead to an area of appreciation, a really large move up in the stock market. Again, we reach that area here. It doesn't lead to an immediate decline, but once we reach the early parts of 2015, the decline takes place. This leads into the 2016 presidential election, which is seen here. We get a trigger to the upside right here, crossing the 20 line. Post-presidential election, President Trump is elected, and then we have this huge bull run in the markets. All right, so that leads to where we are now, which is this stochastic being overbought. Going into 2018, we had a wild market ride leading to a massive decline in 2018, several massive declines, not huge relative to what we had seen historically, but we had many, many large sell-offs that have completely recovered. So at this point, we're looking at this oscillator being actually oversold, which means that it's a value opportunity. Looking at just this indicator, you could say that this is a good opportunity to buy. And again, that would coincide with what we are seeing. So the point is that looking at the yield curve and looking at home prices, we're seeing that an economic recession is on the horizon, which could fare very well for securities in the next 12 to 18 months, which would line up with this exactly. So let's just move forward in time and pretend that we have gone forward in time 12 to 18 months. This oscillator has now had time to make it back above the 80 level, okay? And now we are at an overbought position again, leading into the recession in the following 12 to 18 months. So we need to bring this all together. And so that's what we're going to do here. So bringing it all together, what we want to do is we want to wait for the spread between the yields to increase. Remember, I showed you the slide and I said that we wanted to see it go from a negative value back to a positive value, and only after then do we typically see historically a recession take place. We also want to see sometime during that recession, we want to see the average home price decrease to around $290,000. Maybe the area is $300,000, but currently we're sitting at an average price of about $320,000. So if you're looking to invest in real estate or buy a home, $290,000 is probably a good price point during the next recession. Some people may be watching this and they're in the real estate markets and they can't believe that I'm saying this, but just remember that's what people thought prior to every other recession. All right, watch for stochastics on monthly Dow to fall to oversold. That brings us to the previous slide in which I showed you how the stochastics move from being oversold to overbought, back to oversold, and then back to overbought. So currently they are oversold, and they need to get to the overbought area. But eventually, during the recession, as we see these prices decrease, we'll see them fall back to oversold. So once we enter into a recessionary period by looking at the yield curve, we have the negative GDP, home prices have declined, and then the monthly Dow falls to an oversold position. After all of these events occur, this is literally the best opportunity that you will ever see in your life to invest long-term in the stock market, to invest long-term in real estate, to invest long-term really in anything. Because what happens is, after a recessionary period, we enter into an area of boom, economic growth. And so the best opportunity to invest in the last 10 years was literally at the bottom in 2009 after the previous recession. These opportunities present themselves every decade or so, and what they do is when these things line up, For people who actually have liquidity, for people who have the ability to invest, they're able to make very sound, very smart investments that lead to great appreciation. So hopefully this was helpful to you. I'll ask again, please subscribe, please like the channel, and please leave comments. We want to continue to create content like this, and we want to give you good content that brings you value, that can help you. So if you'll subscribe, like the channel, leave a comment, it'll encourage us to make more content just like this.